moving down. Everybody seems to be losing money. So we're going to take a look at some of the charts. We've got a lot of interesting stuff to talk about. We're going to look at some of the past crashes today and compare them to what's going on now. So we've got some interesting stuff. Good morning, Silver and Flux Force. It looks like you are some of the people who are able to actually look at their portfolios when the markets are down massively, right? So a lot of people, they look at, they wake up in the morning, they check their Robinhood, they check their Webull, whatever it is, and they look and they see that stocks are down and they just shut it off. They don't even want to know about it. And I absolutely used to be one of those people, right? A couple years ago, that's absolutely how I used to handle it. Good morning, Auto Codes. And a lot of people still handle it that way. And honestly, sometimes that's just the best way to go. If you get in the mindset of the markets are down, the day is bad, and you let that ruin your day, then absolutely, right? It makes sense to not pay too much attention on the red days, right? If you're going to let it get in the way of your day, absolutely take care of your health first and your mindset. But if you can handle it, it's actually potentially, sometimes when the markets are red, they present good buying opportunities over the long term. So we're going to look at some potential instances where the markets might be a little oversold, and I think the stream it's working, I believe. So we're using this new streaming software, Restream, and it's just not quite as seamless as going straight to YouTube. So let me refresh this real quick and just make sure everything's working. Yeah, that looks good. So let's see. Good morning, Auto Code, Sub-Zero, Angel Kovac, going lower this week. So yeah, a lot of people think that we're going lower this week. We'll see what happens. Hopefully we'll bottom out soon, right? That's what everyone's hoping for. But there's no telling, right? If you look at the one-year chart of the S&P, you can see we've gone down somewhat significantly already, right? We're down about 8% in the S&P, I believe, close to 9% after the market opens today. We'll see how much lower we open today. Obviously, we are down a bit in the after hours and pre-market, right? So we're going to be opening probably around 4:30 on the S&P. So we're moving down. In fact, the top story that we've got for the S&P is, or for any stock in general, really, the front page of CNBC. Stock sell-off set to continue as investors brace for the Fed. Dow futures fall more than 200 points. So obviously, we're moving down in the markets as of right now, and it looks like the major analysts are expecting that to continue. And oftentimes that can be a self-fulfilling prophecy, right? If people think the markets are moving down, then it would make sense to see them moving down a little bit further as some people jump out. I've actually been surprised to see some of my favorite people jumping out of the markets, and obviously, they gave the disclaimer of they could be wrong, they might be selling at the bottom and whatnot, but we'll see what happens. I don't think that the markets are going to crush too many people. Obviously, you don't want to have any money in that you can't afford to lose, right? That's never smart. You never want to have money that you can't afford to lose in the markets. I'm in the position of, when I buy into stocks for the long term, I'm not using money that if it turned into zero, I couldn't afford to lose it, right? I keep some cash on the side, and I'm gonna probably keep a bit of cash on the side, but probably buy up some of these dips eventually. And Kitchener Leslie says CNBC thinks we should sell all our DWAC. That's right, they do. They think dump it down to zero is what they say. So Rich M, good morning, man. Looks like investors are scared of something. He says, okay, so we can't read it on the stream, but investors are scared of something. So. The markets are moving down, right? SPY, QQQ, DWAC even is moving down a touch, right? It broke down below $70 during the pre-market. We'll see if we can regain that level. AMC on the way down, potentially to new lows. We're getting really close. We're only a couple of cents off from making new lows in AMC. We only need to move down about 33 cents for new all-time lows since the big pump up. So we'll see what happens with that. And Sundial getting destroyed, right? Sundial's down to 43 cents. Absolute insanity. Probably going to have to pick up some more Sundial. We'll see how low it goes today, but it's just getting too cheap. So good morning, Tim Boone, Greg Taylor. Good morning. Welcome, everybody. Shadow Girl. We've got potentially a very scary day for a lot of people, right? We're moving down. A lot of people probably just aren't going to show up, right? They're probably going to they're going to look at their phones and see the big red, and they're not buying anything, right? They're not buying anything. They're not looking at the markets anymore. They're not turning on YouTube. They're going back to bed, right? They're pulling the covers up, turning off the lights. And once again, that's an understandable reaction, but I am not too worried about it. Now, a lot of people are absolutely going to be worried about it because of this study that was done a bit ago, and we've talked about this on the channel before, but for those of you who haven't seen it, basically, this is a survey taken in 2020 to figure out how many new investors there were in the markets, and what they found was that 43% of respondents to this survey had an investment account before 2020, and they maintained it. They didn't do anything with it. They didn't open up a new account, right? So 43% of people just maintained their existing investment accounts. 19% of people had an investment account and decided to open up a second investment account. And 38% of people did not have an investment account and decided to open up an investment account. So 38% of the market entrants, or 38% of people in the markets are supposedly new investors, right? According to this study, right? Obviously, it only surveyed about 1,300 households, but if we're to believe that that was a good representation of the country, then it would mean that about 38% of the people who have stock are new stock market entrants, right? So a ton of new people flooded into the markets in 2020. Obviously, 2020 was a great year for the stock market despite the pandemic, right? If you look at this, we'll pull out a 3-year chart just so we can get all of 2020. But look at this. I mean, 2020, despite the pandemic, still an incredible year for the stock market, especially if you were buying at the bottom, right? The S&P, if you bought at the beginning to the end of 2020, was up 17%. But if you bought at the bottom, or even close to the bottom, around 225, then you were up 62% just in the boring old S&P, right? Absolutely incredible year. And a lot of investors probably got the wrong idea about the stock market, right? They probably saw that and they figured the stock market's easy money. They started and continued to plow more money into the S&P, and we did see in 2021 an absolutely incredible year as well, right? We were up from beginning to end about 26% on the S&P. So, investors just kept on plowing their money in. They saw that they were making a ton in 2020, and they just kept plowing money in. And now at the beginning of 2022, we're starting to get some negative catalysts, right? We're actually starting to see some real reasons why the market might start to slow down, why we might start to fall a little bit. A lot of it has to do with the Fed. We're going to look at this in a second. I'll pull it up right here. But on, what is this? Let's see. The next day that the Fed is doing this is, it's Wednesday this week. The Fed will be giving their rate hike decision. Where did that go? Yeah, federal interest rate decision. Now, obviously, I don't think they're going to raise rates this soon, right? Unless Jerome Powell actually wants to crash the markets. I don't think he's going to raise rates. We'll probably continue to see 0.25. If we pull this up right here, you can see what the interest rates have been. So we've basically been stuck at 0.25% for many, many months. And if you zoom out over the long term, you can see that that's actually somewhat abnormal given the history of the country, right? In the 80s, we had interest rates closer to 10%, and we slowly weaned down and down and down until around 2008, the Great Recession, when we knocked ourselves down to 0.25%, and slowly but surely, right, 8 years later, the Fed decided to start raising rates again in 2016, and then they cut it off, right, at 2020. So they had to do something about the pandemic, and they decided to cut it back down to 0.25%. But they really want these interest rates going higher because we are getting to record levels of debt. We're starting to see quite a bit of inflation, and they need to combat that in some way. And the way that the tool that they have to combat it is those interest rate hikes, which tend to not be good for the markets, right? So they're a little worried about that inflation that we've been seeing. And now stock market investors are a little bit worried about the interest rate inflation that we're seeing, right? That there will be less easy money coming, that less money will be flowing into the stock market. And so people are trying to get out, right? Everyone's rushing for the door, trying to escape the stock market. And we've just been moving down a little bit ever since, right? So it's not the biggest crash that we've ever seen. If you actually look, the S&P, because it has so many large market cap stocks in it, has actually not been too negatively affected, all things considered, right? If you look at some of the small market cap stocks, they've been decimated. But the overall S&P, if you actually look from the highs to the lows that we're at now, we're actually probably going to open up at 430, so I'll do it to there. We're down about 10%, which is significant for the S&P, right? That's correction territory, but it's absolutely nothing compared to what has happened to a lot of the small market cap stocks. I'll pull up something right here. Here we go. This is what we want. So we'll pull this up. And I know you guys saw this on the last stream, but for those of you who are new, more than 1/3 of NASDAQ stocks have slumped 50%. So 36% of stocks in the NASDAQ index have plunged at least 50% from their 52-week highs. So absolutely incredible amounts of stocks have been tanking over the past while, right? The 10% drop in the S&P does not really exemplify that. And JL, thank you for the super chat, man. And when is the mother of all short squeezes? When is the mother of all short squeezes? Well, we're probably going to have to wait for this market to turn around, right? I mean, the market is taking everything down. And it's not like there's just retail in AMC, right? There's institutional investors too. We'll pull up AMC real quick right here. But it's not just retail. It's institutions too at this point. Some institutions, at least, who are in for the short squeeze. And they're selling, right? When the markets are bloody, everything's bloody. AMC is moving down, unfortunately. We'll have to wait on that. So we'll see what happens. But thank you, man. Now, the markets overall, right, pretty bloody, right? We're seeing the S&P move down significantly. That doesn't even exemplify the worst of it. You can look at something like the QQQ, tracks more so tech stocks that are a little bit more volatile. The S&P was only down about 10%, where we're going to open up on the QQQ is around $343, right? That's where we're expecting to open up. And if you go from just right before the end of the year, the highs that we were at, to $343, which is so low, it's not even on the natural chart, but we can do it right here. 343, we'd be down about 15% on the QQQ. Now, it gets even worse if you look at the Russells. The Russells has absolutely been getting decimated. In fact, let's open up the one day. So we'll probably open up around 193. And boy, oh boy, the Russells has been tanking. So from the highs that it was at in November to 193, it is down 20%. So it just keeps getting worse. And once again, the Russells has a decent number of larger market cap stocks in there too. So a lot of these markets are getting hurt, and a lot of them are being propped up by the larger market cap stocks. However, this isn't something new, right? If you take a peek, we'll pull back the S&P over the past couple of years, over the past 2 years, right? This dip that we've seen in the S&P, nothing compared to what we saw at the beginning of the pandemic, right? We're looking at the S&P, we're down about 10% or so. The beginning of the pandemic really crushed stocks, and there was a real reason, right? There were real catalysts for real fear. We fell 35% when the pandemic began, and in a very short period of time, I believe that was the fastest market crash that we'd ever seen in maybe since the Great Depression. I think it might have been since the Great Depression. But even that wasn't that big if you pull out the all-time chart, although we've been having good times for many, many years, right? For over a decade, we've been having really good times in the market. You can see the big pandemic crash right here, where we moved down 35%. That was the most significant drop, but still by the end of the year, we eked out a positive gain, pretty significant positive gain, actually. It's nothing compared to what we used to see back in 2000 and 2008, when from the highs to the lows, first of all, it took years to get from the highs to the lows. We literally, multiple years, we were falling. From the highs to the lows, it looks like we dropped 49, almost 50% in 2000 during the tech bubble, right? And then in 2008, during the Great Recession, we fell 57% on the and this is the S&P, right? These aren't the most volatile, crazy stocks. These are some of the most stable stocks that are out there in the S&P. Obviously, some are volatile, but it also includes quite a few stable ones, right? If we look at the Russells, I wonder if the Russells chart actually goes back that far. Yeah, so from 2000 to 2008, let's see what the Russells did at the height, at their peak. Russells was down about 60%, so nothing crazy, not too much crazier than the S&P. And I wonder, just for fun, if the QQQ, yeah, so that goes back to the tech bubble. So let's take a look at this. So during the tech bubble, the QQQ dropped quite a bit. We'll start up here at 120 at its highs. It fell 83%. So all those tech stocks really crashed in the past. Now, I'm not telling you guys this to make you think that we're about to go through the same thing, right? Because in the past, there were some real big catalysts for why we fell, right? The mortgage crisis and the tech bubble was obviously just a bit of a blunder on valuations for these tech companies. But right now, what people are mostly worried about is the Fed raising interest rates, right? That's mostly what they're worried about. There are a couple of other things that we're going to talk about that could be affecting the markets. Uh, Obviously, we're still in the middle of a pandemic, right? We'll pull up the case counts and whatnot, but we also have to pull up this story that I thought was a little interesting, right? Not too relevant, but global conditions perfect for more variants to emerge. The World Health Organization's Tedros says. So conditions are ripe for a infection to mutate into more variants, and it is dangerous to assume the pandemic is approaching its end game. So we'll see what happens. But that's what the World Health Organization's guy says. Obviously, they get a lot of publicity while they talk about this kind of stuff. So maybe they're just saying it to say it, but we'll see what happens. There was a slightly more scary story going on. Something that really could tank markets if it really gets bad. So we'll see what happens with this story, but it is a little worrying to see, right? Britain is pulling out its staff from the Ukraine, from its embassy in Kiev, as NATO sends warships east to the coast, I suppose, of the Ukraine. So it seems like some countries are potentially really getting prepared for an actual hot war that could be going on between Russia and the Ukraine and whoever decides to support the Ukraine in that war, right? Obviously, Russia, if it was just Russia versus the Ukraine, Russia could probably crush them pretty quickly. But it seems like the United States and Britain and NATO are probably going to support the Ukraine if there were to be a hot war. Obviously, that would not be good for the stock market, right? We would probably see the markets move down pretty significantly if we were going to war with Russia. So a little bit scary to hear that, not only is NATO sending warships, which could just be posturing, but that Britain's actually withdrawing some of its staff and their families from its embassy in Kiev, in Ukraine. So a little scary to see that, right? The situation seems to not be getting too much better, but we'll see what happens. Hopefully, there isn't a big war coming up soon because, if anything was going to actually crash the markets, which we really haven't seen that happen yet. The markets, we've pulled back significantly, but it's not like we've wiped out the gains from the previous year. In fact, if you bought a year ago today, right? If you bought a year ago today and we're just holding until now, then you'd actually be, we can pull this up. So you'd actually be up about 12%. So in no way is this, a market crash yet, right? Are we on the precipice of one? Could something really bad happen and continue to move us down? Potentially, right? In fact, if you look at the VIX, which is the market volatility index, you can see that we are rising quite significantly, right? We're getting pretty darn high. We're not as high as we were actually the last big pullback that the market had, but we're still pretty darn high. And if you pull out the 2-year chart, it's actually nothing compared to what happened during the pit that the market fell into during the beginning of the pandemic, right? So we could actually be rising quite a bit more on the VIX. We'll see what happens, right? Obviously, if there were any kind of war to be going on, I would expect the VIX to move up pretty significantly. Some people are talking about World War III. They're getting scared. I'm not too worried about it, right? I don't really think that Russia is actually going to invade Ukraine. Maybe I'm wrong. Maybe they'll do it. And look at this, actually. Speaking of World War III, unless my computer's listening to me, trending in the United States, World War III. Look at that, right on Twitter. Let's see what this is. Let's pull this up. Hopefully it's nothing inappropriate. I know there can sometimes be inappropriate stuff. Okay, so look at this. Breaking. This came out 14 hours ago. State Department issues do not travel warning for Ukraine as embassy staff is told to leave. Wow, so is this... Yeah, look at that. The United States State Department has ordered the evacuation of American citizens in Ukraine amid the threat of Russian military action. Wow, 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 wow. Huh, look at this meme. Me laughing at all these World War III memes versus me when I get the draft letter. Well, we'll see what happens. Hopefully nothing too bad. But, notably, NATO is sending those warships in. So we'll see what happens with the Ukraine situation. Hopefully it's nothing. It seems like the kind of thing that I do remember happening in the past. Let me see if I can pull up a story the last time. Russia had troops on the border. I seem to remember that somewhat distinctively. So, timeline. Russia's growing threat in the Ukraine. Let's see if this has it. So, Over November 28th, Russia has nearly 92,000 troops for an offensive at the end of January or early February. Jeez. It seems like they're expecting this to happen somewhat soon. So, no, this isn't what we want. This isn't the last time that Russia was invading, or threatening to invade, I should say. So, let's see if we can pull up an article from a couple of years ago and see if there's a way to do that. So let's do a custom range right here. I'll pull it up so you guys can watch. So I think probably from 01, 2014. Let's do that to 01. Let's say 2019, right? Let's see. Okay, so this happened in 2014. All right, so this is from Vox. Everything you need to know about the Ukraine crisis. What is the Ukraine crisis? Ukraine is a Texas-sized country, blah, blah, blah. All right, that's not important. That's not relevant. Thank you, Vox. I'm going to pull this up. We're going to find something about, well, okay. Here we go, 2018. Here we go. Ukraine president warns Russia tensions could lead to full-scale war. Now, this is an old story from 2018, back when a similar thing was happening. I think that, Russia had deployed troops along the Ukrainian-Russian border and had grown those numbers dramatically, and the number of Russian tanks had tripled. And look at that. And this happened in 2018, and it turned into nothing. So overall, it's not the biggest deal, in my opinion, right? I don't think Russia is actually going to do something. Obviously, there is the potential for them to, and that would certainly be very bad for the stock market, right? We would probably, I can't even imagine how sharp of a drop. Look at what we saw during the beginning of the pandemic, right? It was down, what was it, 20, 38, 35%, I think it was. It was down significantly. So during the heat of the pandemic, right, the beginning of the pandemic, we were down 35%. If we actually did see a big war, a hot war with Russia, we're already down, 8%, well, closer to 10% when we're going to open. But, man, we could go down quite a ways. We could go down quite a ways. Certainly, probably to the bottom of where we were at the pandemic, right? I would not be surprised to see that if we did actually have a hot war. Hopefully, that's not the case, right? Obviously, right, if we did have a big war, it would not surprise me at all. The reason I'm saying it wouldn't surprise me to see the markets crashing is because both the United States and Russia and probably a bunch of other countries in NATO have nuclear weapons. So obviously, any one of those going off anywhere would be a huge hit to supply lines, and we're already dealing with quite a bit. Massive debt in the country. Typically, countries take out massive debt when they go to war. And I don't know why we're talking so much about the potential for war. It really wasn't that much on my mind until I clicked that World War III thing. It was just a minor story that I wanted to pull up, but we're going to pull up the national debt just to see how much more debt would we need to take out if we were going to war. So currently we're sitting U.S. national debt at $29,870,341,000,000. So we'd probably need to take out quite a bit. And that actually goes along with something I wanted to pull up, the national savings rate. So, unfortunately, we can't go back too far. We don't have the savings rate pulled up from, before World War II. I did want to pull that up just to see what the savings rate was before World War II. But here's the U.S. savings rate, the personal savings rate. So, currently, we're sitting at a fairly low number, right? If you pull up the past couple of years, we obviously saw a massive spike when the stimulus checks went out. Literally, every time the stimulus checks went out, you can see a massive spike, right? Up to 33% when that first $1,200 check went out, then up to 19% when the $600 check went out, and up to 26% when the $1,400 check went out. So we saw 3 massive spikes in the savings rate, and people were probably a little bit more worried, right? A lot of people had lost their jobs. The pandemic was at its peak. So, when we did dip down, we only dipped down to around 13%. People were still probably trying to save up a bit. But now we're down to 6.9% as the savings rate, lower than where we were pre-pandemic. So we were typically around, 7.5, 7.6, 8.7 at times, 7.5. We typically were not this low. We're down to 6.9% as of November. And, way back in the past, if we pull this thing out, we were typically, back in the 70s around 13, 12, 11, 10, 9, 12%, 13, 14%. So we really have fallen quite a bit savings rate wise, right? There's not that much money stashed away for people to use to buy up, whatever assets are falling, right? So, at least normal people, you and I, right? The retail doesn't have that much money saved up, according to this statistic at least. Obviously, on a case-by-case basis, individuals might have money saved up, but for the most part, people's savings are relatively low, and that's another reason why the market's able to drop so much. Even if people want to buy the dip, they can't. And it's actually something I've noticed in the comment section. I've seen people comment, I just keep buying the dip, and it just keeps dipping, right? They've been buying up stocks as they've been moving down, mostly probably the small market cap stocks. If you look at the Russells, they've been buying these up, and they just keep going down. And now people have run out of money, right? They've run out of cash to actually throw into these stocks to stop the dip. So we're actually seeing a situation where there might not be enough cash for the investments to maintain their valuations, to continue moving up as they had been over the past couple of years. So we'll see what the Fed ends up doing about that, right? Do they decide to raise rates? Will they chicken out last minute? I mean, we'll see what happens with it. I think that the Fed is pretty set at this point on raising rates. They obviously want those rate hikes. They want to start tapering and slowing down the level of inflation. But the need might not be there in the near future, right? If people are really out of cash, then obviously demand for goods and services is going to drop pretty significantly. And I have noticed some trends of that happening, right? Gas prices where I am are down about 5% from where they were a couple of weeks ago. So gas prices have gotten a little bit cheaper. Obviously, other things are a little bit less elastic and less likely to stick exactly to the market price of the goods, right? Gas tends to change day by day, but something like a hamburger, that changes every couple of months. So I haven't noticed too many other changes, but it certainly seems like there is less money out there, and potentially like we might be getting ready for a little bit of a recession. I mean, we'll see what happens, but there are some worrying trends, right? The savings rate is very low, and that's what you have to worry about. When the savings rate is low and the Fed starts tapering and making money harder to come by, that would be a little worrying, right? Especially in the sense that we might start to see more jobless claims coming out soon. Look at this. Unemployment rates. So we've got once this loads, if this would load quickly, that would be nice. I'll pull it to the side while it loads, just so you guys don't have to stare at it. Here we go. So the jobless claims. So if you zoom in on this, we got to pretty low jobless claims. And this is when we were experiencing that peak inflation. Right around here, everyone was working. Everyone was earning money, pouring it into goods and services, just buying stuff up. Now we're starting to see this trend of the jobless claims actually rising. And we get the next number on the 27th. So I think it's this Friday that we have the next jobless claims number coming out. We're forecast to have 260,000 new jobless claims. However, last time we were forecast to have 220,000, and we actually had 286,000. So we might be entering a period of more unemployment, low savings, and more hawkish Fed, which is a little bit worrying for the overall economy. Obviously, individually, we may all have positioned ourselves fairly well. Hopefully, we've positioned ourselves fairly well. Hopefully, none of us are in the boat where we might be in a very tough position sometime soon. I'm hoping that we've all done a good job and managed our finances decently, right? I'm not really worried about this, right? I've got a decent amount of cash. I've got a decent amount of assets. I'm not too worried about what might happen. I have enough cash flow to sustain myself, even if I had none of the assets or cash or anything like that. So I'm not worried about this. But this is something that could worry a lot of people, and this is why I always advocate, although we never give financial advice on this channel, I always advocate for never putting in more money than you can afford to lose in the markets, right? Because you never know what's going to happen if we're going to start to see a bad situation coming. And if stocks are going to crash, and if you had money that you needed in the markets, that could be pretty brutal. Now look at this. Look at this gap down that we just saw in the S&P. How much did it gap down over this weekend? Look at that. The S&P is down in a big way, down 1.25%, 1.3% gap down in the S&P over the weekend. And it looks like Sundial's, right before the market opened, it looks like some people bought this dip. pushing it up about 2 cents, but we're still down 6% on Sundial. AMC just made new all-time lows, down at $16, and DWAC is not looking much better than the rest of the market, right? It's down 9% since the weekend started. So we're down pretty significantly in pretty much everything, right? The S&P's suffering. All our favorite stocks are suffering. But overall, I'm not super worried about it, right? Over the long term, right? And it's obviously different for everyone. If you're in these things as a swing, then maybe there's reason to be a little bit worried, right? If you were taking a day trade over the weekend and it just took a 10% dump in your favorite stock that you're investing in, then maybe you have a little bit to be worried about. But if you're in these things over the long term, then once again, these kinds of fluctuations are nothing new. We see them time and time again over the course of years. Obviously, this one's a little bit more significant than what we've seen since the initial dip from the pandemic. We have seen some dips, but nothing quite this significant. But there's a first time for everything, right? You can't expect the markets to just be up and up and up forever. But there are times when we do see pretty significant dips in the market, right? We do see in the past, let's see what we had in 2015. We were moving down from the highs to the lows. We were down about 15%, so a bigger dip than what we saw. And then just a couple months later, we were down 15% again. So overall, I'm not the most worried about this, right? We see dips every now and then. Whenever we get to peak fear, I always notice it. People just sell everything, right? They think the end of the world is coming, and potentially, potentially at any point the end of the world could come, technically, right? Especially with this whole Russia-Ukraine situation, right? That is a little worrying, I have to admit, that NATO is sending warships east, that the UK and the US are pulling their staff out. That's more worrying to me, because sending the warships east makes sense from a posturing perspective, right? You want to have, if Russia has, all their troops on the border, then you want to have some of your troops on the border just to kind of dissuade them from doing anything. But if you're actually going through the trouble of pulling out your staff, then that means you think something might actually happen. And the fact that the US and the Ukraine are doing that almost is a negative thing for this situation, right? It shows Russia that the US and Ukraine are somewhat worried about their staff being hurt, and that maybe it wouldn't just be a one-sided, instant obliteration of the Russian forces. Maybe the US and the Ukraine have something to fear, is the vibe that I'm getting, because the US and Ukraine have just been pulling out their staff. So we'll see what happens. I'm not super worried about it, once again, because we have seen this exact situation in the past, where Russia has troops on the border and they're scaring people, and we send in our troops to dissuade them. But it is potential, not to sound really bearish, but it's a potential world ender. Whenever these superpowers with nuclear weapons start to bar their teeth, it's a potential world ender. Not to scare anyone. I don't actually think that the world is ending. But, whenever that kind of a thing happens, just the fact that we have these weapons of mass destruction means we really could, at any point, anyone could do it, just start setting them off. And that certainly wouldn't be good. And Paddink says, the more you say you're not worried about it, the more worried I get. That's my bad, man. I'm going to stop talking about it, because the more worried I get, honestly, the more I think about it. But nothing to fear, folks. We'll probably see the market start to rebound any second now. We'll just start to shoot up all green from here. So no, probably not. I think the markets probably have a little bit more pain ahead of them, unfortunately. Once you start to get this much momentum behind you and you start to see these gaps down, that's when it can get pretty bloody. So we saw it back in March of 2020. We'll see what happens now, how far we'll go. But I will point out that it's almost a good thing, right? If you have any cash on the sidelines, if you have any cash flow, then over the long term, these dips are actually really good for your portfolio. And I'll show you why. If you look at the 2-year chart, we'll see, we'll look back to 2020, right, on the S&P. Maybe we'll pull out the 3-year. So if you were investing in the S&P, and say the whole pandemic hadn't happened, say we never had this big dip, and you just rode the S&P, maybe we'll pull out the 2-year. I think the 2-year is better for this. So maybe you just rode the S&P from March to May, June, July, wherever it is, August, and you just rode the S&P for a couple of months from one peak to another, you were up 17%, which is good, right? You'd love to be up 17%. Any day, that's a great day. Or any year even, that's a great year, right? If you just rode it from this peak to this peak, you were up 17%, 19% maybe, depending on when exactly you sold during that day. But still, awesome gains, right? You'd be happy to have it. However, if you decided to buy on this big dip and maybe you were buying close to the bottom, you had the opportunity to be up, instead of 17%, 60%. So really significant. And I mean, say you were doing that in something a little bit more volatile like QQQ, from one peak to another. If you bought right before the pandemic hit, you were up 27%, right? Even though we had a big dip right afterwards, right, where you were down 28%. So you might have been down a quarter of your portfolio, might have just been wiped off the face of the earth. And a couple months later, you were instead up 27%, right? Up a quarter of your portfolio. You never know what's going to happen. But if you were buying on this dip and you actually bought in near the bottom, or even not even that close to the bottom, kind of close, but not that close, you were instead up 60%. And if you really caught the bottom, if you really were buying on the very bottomed out day, you were up 81% on your investment, just buying into an index fund. I mean, you can really make great gains because of these big dips, and you sometimes have a more sustained growth period right after, right? When you see this massive tanking that we went through, it provides more time for the market to go up, because we went up and up and up for months before we even got to the highs that we were at before, right? So we went up. We had to, from where we fell to, we had to go up. What is it? We had to go up 41% just to get to the all-time highs that we were at before. So you already had a 40% opportunity before you even hit any significant resistance levels. So pretty cool stuff. Pretty cool stuff. So these market dips, sometimes they can actually be a really good thing for your portfolio. The situation where they aren't good for your portfolio is if you have everything invested and you notice this thing going down, you get kind of fearful, and then you sell out on the dip. And that can be detrimental, right? Obviously, if you buy back in cheaper, then that can be great. But I'll tell you guys, that's really tough to do, because when we were seeing this dip back in March during the beginning of the pandemic, I certainly, though I was buying up on actually some of the lowest days, did not think that we were done with it when we started moving up. For a long time, I thought, man, this is a huge fake out. I was thinking a ton of people are going to get slammed on this. When we were moving up, a lot of people were probably buying in, thinking, "Oh, this whole thing's over." And I was one of the people thinking, "No way, this is over. We're about to fall off a cliff in a couple of weeks, and I'll buy up more then too." But we ended up just moving straight up. So the markets, you can never predict exactly what they're going to do. But my point is, if your goal is just to kind of speculate when you think this whole thing is over, when is this crash going to end, when is the bottom, when should I be buying in, you're probably going to be a little bit late to the party, right? You're probably going to have seen the stocks been rising for a while, even though there's still, massive fear around whatever negative catalysts were driving the markets down in the first place. And you're potentially going to get in at a higher price than where you sold out, right? That's my worry. That's what I've noticed can happen. I mean, look at this. We're seeing some green today. Maybe this is the bottom. Maybe even though we're at peak fear, we might just be on the up and up from here on out. It's possible. It doesn't seem too likely, but then again, back in March 2 years ago, it did not seem too likely that this was the bottom either, right? Everyone was still incredibly fearful. So we'll see what happens. Now, Silver brings up a good point. He says, do you chase 10% at the risk of 30% drop? So the way I view it is that you're not necessarily chasing 10%, right? At the risk of a 30% drop. You're chasing infinite gains over the long term, right? You're just buying and holding. If you're investing, right? Obviously, if you're swinging stocks, then that's a different story. But it's essentially infinite gains over the long term, right? These valuations just keep going up and up, and we just keep printing more and more money, and the dollar amount that these stocks are worth goes up and up and up over the long term. Now, I view this whole sell and buy back in later as chasing the potentially 10% gain of maybe I can buy in 10% cheaper, maybe I can get it 10% less. maybe I can get it 20, maybe I can get it 30% less. And just trying to pick the bottom, and inevitably, unless you think the U.S. is going under and we really are doing World War III and everything's going to zero, inevitably, over the long term, these stocks are going up, right? So maybe you can sell right here and buy back in right here, and you'd have made the extra 10%. But over the long term, if you're in a buy and hold strategy, it makes more sense, in my opinion, right, to just buy in at the beginning, and say 10 years ago you bought in, and then you're up. Where is it? So you buy in here, and then you're up 200% over a couple of years, right? Whereas, maybe on these dips, maybe you sell out when it's been falling a bit, and you try to buy back in. But if you forget, or if you don't think the dip is done, and you're back up, well, you've lost your 8% right there. So I don't know. I get a little worried about it. Obviously, everyone likes to do it. Everyone likes to do it a little bit differently. But Zach Taylor says, "How is the U.S. dollar rallying?" Yeah, look at this. The dollar's going up. And the reason the dollar's going up is because the same reason the market's going down. Everybody's worried about the Fed decision. They're going to raise interest rates. Oh, the dollar, it's going to become so valuable because you can put it in a bank account and earn 0.25% on it. It makes no sense, right? Why people are flocking to the dollar. Look at this gold, though. Gold started the day higher, and now it's moving down. But yeah, the dollar, I've been of the opinion for a long time that cash is trash. And unfortunately, the dollar chart doesn't necessarily show that, but the inflation chart certainly shows it. If we'll pull up the inflation chart. So let's see. No, not that. We want value of the dollar. So I think we can find this right here. I'm pretty sure this should be it. So here's what the value of the dollar has done since its inception. Once it loads, I'll pull it right up for you guys. We'll pull up SPY real quick too. Man, this is taking a second to load. Look at this. I think that they're worried that people are just going to start buying up stocks and end this crash right now if they see how much the dollar has crashed. If they ended up showing people this statistic, everyone would be out of dollars. No one would hold the dollar. Inflation through the roof. Once people see this chart. But man, it sure takes a long time to load. They really don't want to show it to us. So let's try reloading the page and see if that'll do something. But man, that's not good. That's not good. Look at that. It just doesn't want to load. So we'll try pulling up a different page. Maybe this one will do something. No. That's not a good chart. We want something visually appealing for you guys. This is weird. I don't know why this chart, it just refuses to load. But basically, I can tell, or maybe we can try downloading the PDF. Let's try that. Oh, we got to purchase it. All right, that's not worth it. So basically, what this chart would show you, if it would pull up, maybe we can actually pull up an image. Because it is, here we go. This is what we want. Let me pull this up in a new tab so you guys can see a nice image. Open image, new tab. Here we go. So we'll just have to zoom in a little bit on it. And it's a little blurry, I apologize, but here's the buying power of a dollar from 1860 to 2020. And you see it started at $1 way back then. I'm sorry it's a little bit blurry, guys. And, it crashed. Excuse me. And, for a couple of years, it was on kind of stable footing, right? It would move down, it would move up, and you didn't know if the dollar was going to become worth more or worth less. But ever since about 1940, ever since the Great Depression, really, it's just been down and down and down. And the only thing is how slow or fast does it fall, right? We've just been printing more, and it's just been falling. And now $1 is worth, probably 2 cents or 3 cents compared to the dollar in 1880, right? You could probably buy 3% of what you could buy for $1. So overall, that's why I do not like holding cash, because the long term has shown it is not kind to anyone holding cash, right? If you just held cash for 100 years, if you had if you had $100 in 1880, you've got about 3 cents worth of value left of that, right? Because the $100 could have bought a whole lot more back then than it can buy now. So really, really scary stuff if you look at the long term of what happens to the dollar. And you can see stocks are starting to move back down. The S&P is starting to move back down. Sundial even. having some volatility, honestly, but not making new lows. Not going below 44. It looks like it might be using 44 as support. And AMC hit lows of 1590. Let's take a peek at the daily chart on that. So yeah, AMC is moving down. DWAC looks like making new lows on this thing, down to 65.8. Scary stuff. Scary stuff. But once again, not scary if you're in this for the long term. In fact, every time the market moves down, you can potentially just view it as a better buying opportunity, right? There's always that point of view where if you look at this thing over the max, or even over the past, I like that 3-year example of during the pandemic, right? Because we really haven't had that many dips lately, where you can look at it as, if I'm investing for a couple of years, you're either buying on the up and up, or maybe at this peak, and to where we are now, you're up 28%, or even if you just bought halfway down this dip, there was still minus 20% downside, right? You could have still, if you bought halfway through this dip, been down 20% over the next couple of weeks. If you were buying right at the heat of the pandemic, right in the middle of it, you could have still been down 20%. But if you held until now, you're up 56%. And in just a couple of months, you're up 15%. And it just kept going up and up until you'd be up 55% now. So 50% more money just from buying. And that's the boring old S&P, right? We're not even talking about. Let's pull up IWM, the Russells over the past 2 years and see what it would have been. Obviously, the Russells hasn't done that great, actually, over the past year, so it's probably not going to be as significant. But, say you bought halfway through the pandemic, and to the bottom, it was down 28%. And if you held until now, let's see where that would be. If you held until now, you'd still be up 44%, even on the Russells, even on these small market cap stocks that have been getting dunked on. If you sold at the high, you were actually up over 80% on the Russells. So there is certainly a lot of potential in the markets on these big dips that you see. And hey, maybe we're not at the bottom yet, but maybe you want to lock in some slightly cheaper prices, right? You haven't been able to get stocks this cheap since what is this? October. So October was the last time. Now, granted, that's not that big of a time period, but if you ran into some more money over the past 3 months, then maybe you want to throw it in. Obviously, I'm not recommending that anyone throw in money. I actually personally think we're due for a little bit more red. But Silver says, Rob, check out NXU. We'll take a peek at NXU. We need a new stock to look at, a stock to buy on the dip, right? There's a bunch. So Novus Capital. So let's see. So it looks like it's pretty much always been below $10 for the most part. Let's see, NXU. We'll pull this up on Google and see what they're all about. Is this a SPAC? Okay. So I think it is a SPAC. No, is it a nonprofit organization? No, it couldn't be listed if it was. So let's see what this story is. Novus Capital and Energy Vault announce effectiveness of registration statement and the February 10 special meeting of stockholders to approve a business combination. So it looks like it's a SPAC, probably. Publicly traded special purpose acquisition company today announced that its registration had been declared effective by the U.S. So Energy Vault, that's what we will want to look at and see. What is Energy Vault? That's what will tell us what NXU is going to become. I certainly like the sound of Energy Vault. It sounds cool. Enabling a renewable world. Oh, I think we've looked at this before. Novus Capital and Energy Vault announce effectiveness statement. All right. So what is this? It's going to have a big energy storage facility. I see what they. Yeah, we have looked at this. That is a very cool. That's a very cool idea, right? Just having these massive battery banks in the middle of the desert. It looks like, or maybe it was hydrogen that they were using. I forget exactly. I remember I remember very vaguely that we looked at this, and I think that maybe it wasn't a battery. I think it might have been like a hydrogen storage kind of thing. Let's see if we can find solutions. So yeah. They had all these their gravity energy storage. So yeah, really cool stuff. Most of it is probably going to fly right over my head if I'd have to look into it for a while to really understand what they're doing here. But Energy Vault's gravity energy storage solutions harnesses the fundamental principles of gravity and kinetic energy to store and dispatch energy by lifting and lowering composite bricks or mobile masses made from recycled and locally sourced materials. Energy Vault's breakthrough technology was inspired by pumped hydro plants that rely on the power of gravity and the movement of water to store and discharge electricity. The company's solution is based on the same well-understood fundamentals of physics and mechanical engineering used in those plants, but replaces water with custom-made composite bricks through an innovative use of local, low-cost materials. Okay. So they autonomously orchestrate the lifting and lowering of bricks, storing the potential energy in the elevation gain, and generating and then discharging electricity as the bricks are lowered. Importantly, the bricks are made from locally sourced blah, blah, blah. All right. So that's potentially a very cool solution. I wonder how effective it actually is. Silver says play the video. I bet that's allowed. I don't think it would be copyrighted as long as they're not playing some crazy music in the back. So we'll see if they start playing music. I'm gonna turn it off, but let's see what they've got.
Energy Vault develops gravity energy storage solutions and energy management software to accelerate the global transition to renewable energy. The Energy Vault Resiliency Center is designed to improve.
They are playing some kind of music in the back. You know, better safe than sorry, man. I'll look into it and maybe we'll play it in the future. But let me quickly maybe just turn off the volume. You guys got subtitles there, and we'll do it without volume, so we can just see very briefly what they're up to. So how does it work? So okay, so they've got a big facility, a bunch of linked up metal beams and whatnot. Okay, so that's more that's more advanced than what I thought they were doing. I thought that they were literally, I don't know why this was my image of it, but I just envisioned a big warehouse with a rope pulling up a huge pallet of bricks in the middle of it. Something very inefficient, but Brian Steezy's channel says, Rob never answers my questions. Kind of over. All right, I'll look at what you've been saying. I sadly have been looking at the comment section less and less. So Brian Steezy's channel says, what's the best explanation on why every stock has the same chart movement at the same time? Yeah, we'll look at that in just a second. In just a second, we will look at that. But there is a good reason for it, right? So, all right. Very cool, though. So I like this whole grid system that they've got going on. It seems, a lot more efficient than what I was imagining when I was envisioning this. So the reason that a lot of the stocks have the same movement at the same time is because a lot of the time, we'll pull this up, actually. We'll pull up, this is a very cool statistic. So let's pull this up. All right. Let's find the actual statistic right here. So there's only a couple where it could be. All right, here we are. So algorithmic trading is a massive reason why the charts tend to be very similar. Now, first of all, something to understand is that if stocks are in an index fund like the S&P, a lot of the time, people are trading this index fund, and to balance out the portfolios, to balance out the index fund, right? When money flows into it, you've got to buy the stocks that are in this fund, and that will cause the stock prices to go up very similarly. You've also got to, if this thing is having money flowing out of it, sell the stocks in the fund, causing the stocks to move down in a very similar fashion. Now, that applies to the S&P, but there's a ton of things like mutual funds where you've got to do the exact same thing, right? If anyone makes an ETF, and is marketing that, then it's affecting a bunch of stocks at the same time. And if people are putting money into that ETF, then you've got to trade the stocks in the exact same way, and it can lead to very similar price movements. But a huge reason why a lot of stocks, if just a news story comes out and it's not necessarily the index funds affecting them, is that algorithmic trading is accounted for around 60 to 73% of the overall United States equity trading. And that actually means that as soon as a news story comes out, if a news story comes out about there's a new battery technology, or there's a new, a new EV innovation, then maybe all the EV stocks start moving up right at the same time because these algorithms are trained to look for something that's bullish news for EV stocks and just start buying them up at the exact same time. So there are a couple of reasons why you tend to see the stock prices moving very similarly, right? A lot of it is just the index funds because they're very impactful, very influential. A ton of people have realized that a very easy way to, over the long term, at least historically, secure a gain is just put money in the S&P and let it ride. And you get, on average, over the past, what we've seen, you get 12%. So we'll see. We'll see if that continues to be the case. But a lot of people just buy and sell the S&P. They don't bother with individual stocks. In fact, one of my friends was talking to me about it, and he was into investing and whatnot, and he just decided, it's too much stress. I don't want to look at it. I'm just gonna, he's getting his paycheck every couple of weeks, and he's just putting it into ETFs, and he doesn't want to deal with it. So that certainly is a route that a lot of people take, and it does have an effect on moving stocks prices all very, very similarly. I always thought it was kind of interesting. Yeah, so it is very interesting. Brian Steezy says market makers and institutions are in control more than retail, I suppose, but it's ironic seeing the same copycat on certain popular stocks. Yeah, market makers and institutions are definitely more in control than retail. In fact, we can keep, right, if we want stocks to go, we can keep buying up these dips and whatnot. But at the end of the day, me and the 96 viewers on YouTube and the 15 people on Rumble, even if we all poured all of our money into a big stock, it's not really going to have any impact on the price, right? If we all worked together and did it, it wouldn't have too much of an impact. The 115, 20-ish people that we've got here, it's not going to have too much of an impact. Now, if we did it on a smaller market cap stock, like a really small illiquid stock, we probably could push it up, but then we'd just be pumping and dumping ourselves, right? So it wouldn't actually be that great. But institutions and the hedge funds, especially, when there's a sole decision maker, when you're looking at someone like Cathie Wood, who has billions of dollars under her direct control, essentially, right? She's in charge of ARK Invest, and she's got billions of dollars. Obviously, it's fallen a lot in recent months as a lot of her favorite stocks have been tanking. But when individuals have a ton of control over a large amount of money, they really can affect the prices of these stocks and assets, and in a pretty significant way. They can really move them. Day to day, they can push them up by multiple percentage points if they really want to. And it's very cool that they can do it, right? It's cool that they've gotten to a point where they're powerful enough to do it, but it's also relatively scary for the rest of us. If we also want to make money, then it's a little scary to see. So sometimes they do use that power to take money from retail, right? They push down, they short things that they know retail is heavy in, and it is too bad. It's unfortunate, but that's how they do it. So that's the way things go. And not just in the stock market either. I mean, if you look back throughout all of history, whenever people have a lot of power, right? And nowadays, power tends to be a very popular form of power is financial power, right? You have a lot of leverage, and you can manipulate markets and do all that kind of stuff. The world has gotten a lot less violent. It used to be, how many soldiers do you have in your army, right? If you were talking about, 500 years ago, if you were the Vikings or a British lord, then your power was measured in how big is your army. And it did tend to be the case that, if you had one guy in control of the army, then it was a lot more effective than if you had a bunch of lords squabbling over, let's get the army together here. No, let's get it over here. I'm not sending in my troops unless you guys send me more bread or whatever it is. So it does tend to be, the individuals who have amassed a large amount of power for themselves. They can just make decisions very quickly and effectively, and that did tend to win out the day, like in the past when it was armies fighting, and nowadays when it's money moving in the markets, that tends to be a very effective way to have money controlled as well. To have one person in control, obviously, with a bunch of advisors around them, right? Instead of having a bunch of scouts and analysts of the war, and people, generals or whatnot, you'd have a bunch of stock market analysts next to you, looking at different companies, different valuations, telling you where is the smartest place to put your money to grow it. So we'll see what happens with the markets, how long these big players want the markets to keep falling, because at any point, the markets do not have to be falling, right? It's because people are selling big. If you look at this volume, we're certainly getting some big volume. At least on Friday we were, and even today we've already traded 34 million shares in the S&P in the first 30 minutes. So we'll see what happens. How much longer we keep falling. But Vivi says, "Hi, could you look at LRCX, please?" We'll take a look at LRCX. Lam Research Corp, $588 per share. and it has it has tanked lately, along with the rest of the markets, right? So from its high, or from its more recent high to its low, we are down about 20%. So overall, it could be worse, right? It could be worse. Let's pull up the Yahoo Finance and see. Let's see what we got on this. So LRCX, Lam Research Corporation. So $82 billion market cap. So obviously not a small market cap stock, trading at a 20 price to earnings ratio. More reasonable than some of the bigger stocks like Microsoft and Amazon and all that. But what do they do? Let's see. So we've got a question from Max Pierce that we will look at in just a second once we look at this. So company profile, and it's a Dogecoin question. So we will be very interested to hear that. So Lam Research Corporation designs, manufactures, markets, and refurbishes and services semiconductor processing equipment used in the fabrication of integrated circuits. So it looks like they make equipment to build semiconductors. And obviously, if you guys have been keeping up with the used car market or any car market or the Bitcoin mining market, the crypto mining market, you know semiconductors are in high demand, right? A lot of people need semiconductors. There's been a shortage. There have not been enough cars lately. The chip shortage, you guys have probably heard of it referred to as that. But yeah, so it looks like they make the equipment used to make semiconductors. So that is pretty cool. Obviously, their stock price is not too accessible of a stock price, right? You got to put $592 if you want a single share in this thing, but it has been doing incredibly well lately. We obviously went through a big dip, as have a lot of the semiconductor companies. Like if you look at NVIDIA, it's down pretty big over the past couple of months. And potentially, I'm not sure about this, but my cousin was explaining to me that, cryptos, or Ethereum mainly, used a lot of semiconductors. I believe it was a lot of graphics cards, actually, to mine Ethereum. And now that Ethereum just went through the switch from Ethereum to Ethereum 2.0, from proof of work to a proof of stake, and, don't quote me on this because I'm not the best with cryptos and whatnot, at least understanding, how they work. He was explaining that since they changed from that proof of work to a proof of stake system, instead of using graphics cards to mine, they would be using computer processors more. And so we would likely see a big surplus of these graphics cards coming through soon because they know a lot of the graphics cards are just being used to mine Ethereum. In fact, a majority of them, I think he was saying. I don't have the exact numbers on this. I don't know for sure. But let's see. I wonder if we could find this. So let's see. No, that's just a forum. That's not going to give us what we want. Okay, but look at this. Look at this. This isn't going to tell us exactly, but 700,000 graphics cards were bought by crypto miners in early 2021 alone. So obviously, a ton of graphics cards are purely bought by crypto miners. Now that Ethereum is switching to that proof of stake system, I believe they're going to be more processor heavy, and potentially we won't have as much of a need for graphics cards. So for LRCX, I might be a little worried that it will fall with NVIDIA. Obviously, we're still going to need graphics cards and all the stuff that they're making in the future, but they certainly have been on a monumental run over the past couple of years. A lot of it, I think, due to this crypto craze and a ton of people trying to mine cryptos. And we'll see. Obviously, there's still going to be some cryptos that use the graphics card method, but I think Ethereum is switching mostly away from that. So I don't know. I'm not sure about this. Would I be buying it at these prices? It's still pretty pricey, it looks like. But obviously, I'd have to do a little bit more research than that. But now we will get to Max Pierce's question. Hi, Rob. With Dogecoin being around the lowest it's hit, would you buy into it at the moment? So I'll pull up Dogecoin, and I'll tell you what I think about Dogecoin. I made a lot off of Dogecoin in the past, but now my Dogecoin position is red, but I sold most of it, right? So I sold most of it for a gain, but it seems like every day we're just falling massively, not just with Dogecoin, but with all the cryptos, right? Dogecoin is actually down less than Ethereum is down percentage-wise. It's down about the same as Bitcoin. They're both down about 7%. All the cryptos incredibly red today, right? A lot of this worry around inflation not being or being dealt with more harshly than what people were thinking, with the Fed really actually becoming fairly hawkish and raising interest rates and cutting the taper. A lot of people were betting on cryptos because they wanted an anti-inflationary asset. A lot of people were doing it for that reason. Obviously, some of it's just a technical pattern. They saw a bounce off of the all-time highs, pretty much the same level twice, right? Around the $60,000 level twice, 65s, and it's a double top pretty much. It's not quite a double top, but it's pretty darn close. And now we're moving down on a lot of these cryptos, right? Bitcoin's moving down. Everything's following Bitcoin. So would I be buying more Dogecoin? Well, the answer is no, I'm not buying more Dogecoin. It's the kind of thing that I have a little bit of in my portfolio just because I did make quite a bit off of it, and I want to just hold a little bit as one of the cryptos that might be doing well, right? I never pour too much money into just purely buying cryptos, right? A small percentage of my overall portfolio is in Bitcoin, Ethereum, Dogecoin, Shiba Inu. The reason that I hold Bitcoin and Ethereum is because they're both the two big dogs on the street, right? They're major players. Maybe they'll actually, have some kind of value in the future other than just speculative value, which is currently what it seems like they mostly are at this time. At least they're mostly speculation that they'll be worth more in the future. Dogecoin is more of me banking on Elon Musk to continue supporting it, right? Obviously, he has the ability to purchase some of his merch at Tesla with only Dogecoin, right? It's the only way to buy some of that merch at Tesla. So I'm hoping that he continues ramping up support for it and has maybe some kind of long-term plan for raising the price. Maybe. I don't have too much in Dogecoin, right? I'm not too worried about it. I've sold most of it. I've got some in Shiba Inu just because it did explode like Dogecoin, and then I'm still sitting on a gain, I think, with Shiba Inu, but I sold most of it on the run up, and now I'm just holding a little bit. I'm trying to think if I hold any others. And SafeMoon, obviously, right? SafeMoon. But I think that, Dogecoin, am I just going to start plowing money into Dogecoin? There's nothing too fundamental about it that I think, makes it, that gives me a good reason to want to buy it. Like, I can't think of any huge catalysts that would be coming up. Maybe if I looked into it and really got into the weeds of Dogecoin, I could see, they're expecting to throw the Doge event, XYZ, whatever it is, in a couple of months, and that should pump it up or something. But I don't know. I'm not too bullish on just buying crypto coins unless there's a reason to be buying them, right? SafeMoon makes a very good argument for why I like buying SafeMoon, because you just perpetually get more SafeMoon put into your account for holding it. Dogecoin doesn't do anything like that. Neither does Bitcoin or Ethereum. I guess I could stake the Ethereum if I wanted to. If freaking Robinhood would give me access to a crypto wallet, then I could actually transfer it out of there. But regardless, I'm not buying more Dogecoin, even though, maybe if you just want to trade Dogecoin, maybe you could be buying in, hoping that it will rise eventually when all the cryptos go up. Probably inevitably, but we'll see. We'll see what happens. We'll see what happens with Dogecoin. I don't know. I'm not buying more necessarily, even though it is dropping. There's probably more to go, right? It's not too concrete of a crypto, right? It pumped up big. It got a lot of popularity, but it might have just been that might have been its eclipse. We'll see what happens with it, though. Hopefully that's not the eclipse. Hopefully we do get Dogecoin to $1. I know a lot of people are hoping for that, and I would be happy to see it too, right? I'm holding some Dogecoin, so I'd be happy if it went to $1, but it's not the kind of thing that I want to bet big on. So Lex Lucy says, buy the bottom, y'all, but buy some puts on your long-term investments too. That can work, right? You can use the puts as a form of leverage, like in the S&P, right? Maybe you look out until April or so. You say there's probably going to be some significant risk in the markets. Let me buy some puts on the S&P. They're honestly they're kind of expensive. I really don't like buying puts as a hedge against crashes, but I don't know. I'm not the biggest fan, because look at this. Even if you want to sell buy the $400 puts, you're paying $14 to buy them. And that's assuming that, the S&P drops down to 400 and then it drops down to 385 before you break even on the put. and then maybe you start making some money, if it drops more than you've saved yourself a little bit. But once again, it only lasts for a couple of months, and I don't know. It makes sense, if you think the markets are going to crash and tank, maybe you want to buy up some puts in the hopes that you can flip them for a big profit come, a week from now. If you think they're going to go up in value a ton, maybe you can flip them for a quick profit, but buying them as a hedge so you can actually sell out of your stock, I don't know. I'm not the biggest fan of it. Obviously, it obviously makes sense to some people, and they do it. Some people, I'm sure, make money. And Lex Lucy says day trading the puts. Yeah, that's a way. That's definitely a way to make some significant money. I know some people who made some real money off of puts back during the pandemic crash, right? That was certainly a profitable time for buying puts. So we'll see what happens. And Silver says, Safe Moon, Death Sun. Don't know what it means. I don't know what it means. And Kokomo Joe says, I like Rob's channel. We, the small investors, need all the help we can get. I appreciate that, man. I do my best. I mean, obviously, I say it every time. I'm not doing financial advice here. I'm just talking about giving my opinions away on what I think about the markets. And, if I think the more opinions people have in their portfolio of opinions, the better, right? Because obviously not everyone's going to think of everything. I love reading the comment section for that reason, hearing what you guys think about stuff, because minds together are a little bit more effective, I think, than minds alone. So it's definitely a good idea, to hear as many opinions as possible, even if it's something you disagree with. It's very useful to hear that opinion and then formulate a reason, well, why do I disagree, right? Why is that not the right answer? And then you strengthen your own position if you can, right? Maybe the other opinion that you've heard, even though you might not like it, maybe it's right. Maybe someone says the markets are going to crash because nukes are in the sky flying to other countries as we speak, and that's the end of it. And you think about it, and you're like, yeah, I can't really see a way out of it. The markets probably are going to crash. The world's ending, right? That's not actually happening, right? That was just an example. But sometimes you do have to change your opinion, even if it's not an answer that you want to change it to. I think that's important. Now, look at this. The market's moving down, and the VIX is soaring. The VIX is up massively. Look at the past. If we take the VIX from the bottom of where it was 30 days ago, just about, or maybe 20-something days ago, from its lows to its highs, it has more than doubled. So in about 15 days or so, you could have made 127% profit. Obviously, you can't buy the VIX, but you can trade options contracts on it. So if you were buying some of those calls way back when, some people made money, right? Some people made big money because there were open interest. There are constantly open interest call options on the VIX. Whatever strike price, whatever strike date, there are people who have those. Even if the market's not crashing, just as a hedge against a big crash, people have bought those call options. And boy, oh boy, are those printing right now. I mean, look at this. For how far out we've gone, granted that one's in March. If you look at something closer to February, you might have been buying the contracts for 10, 20, 30, 40, 50 cents, and they might be worth several dollars now, depending on how low you were buying those contracts at. So you could have made quite a bit of money in the VIX, as you could have in SQQQ. If anyone doesn't know about this one, this is one that I like. It's a leveraged ETF. It basically is just the inverse of QQQ. So those of you who don't know, QQQ is very similar to SPY. It's an index fund that tracks some of the larger tech stocks in the S&P, and then all you have to do is put an S in front of it, and it's basically short QQQ, right? And you can see that over the past 30 days or so, we'll pull up the 30-day chart, we've done extraordinarily well. So from the lows of this to the highs, we are up 62% because QQQ has been dropping. So you're up massively on this thing if you were buying into SQQQ. So can you look up why Wells Fargo and banks shut doors on Friday? I did not hear about that, but I will look it up. So Wells Fargo. There was actually, I tried to go to the bank the other day, and freaking thing, it was closed. Bank of America. I don't know if that was that was a couple of weeks ago. So here we go. So 3 days ago. Here we go. U.S. banks close record number of retail branches in 2021. Wells Fargo shutters most. Oh, wow. So on net, U.S. banks closed 2,927 branches last year. And mine was one of them. Mine closed and consolidated with another branch. So Wells Fargo was near the top net branch closure in 2021, closing 267 retail locations. U.S. banks closed a number of retail locations as customers increasingly turned to digital banking and the industry consolidates. Wow. So yeah, that's actually something that I could have seen coming, right? I could definitely have seen coming that we're probably going to have less banks in the future. And I think it might be a little bit premature. It's still a little bit difficult to move money, in my opinion, online. I mean, it's easy. Don't get me wrong, but it tends to cost a fee if you want to move larger amounts. And what I always found was to be useful was just going to the bank, taking out cash, going over to the other bank, and putting it in. And then it's guaranteed. You don't have to mess around with hoping that you typed in the right routing number and the right account number, and that you didn't just send your money into oblivion to somebody else. I always liked just taking the cash, having it in my hand, and moving it to another bank. And that's what I like to do. Obviously, I'll still use online transfers and whatnot. I'll use Zelle sometimes, but man, does it just seem a little risky? I don't know. I mean, obviously with Zelle I trust, but Zelle, the thing is you can only move a couple of thousand per month. And sometimes you got to move more than a couple thousand. It's something low, like 3,000 or 4,000 per month. And it's kind of annoying, but whatever. But yeah, it looks like they're closing branches, and it makes a lot of sense, right? I mean, these big banks are definitely going to have trouble if they keep all these locations open, competing with these online banks. I mean, SoFi just got their banking charter, right? So SoFi online, pretty much exclusively online. I don't think they have any retail locations. Just an online bank now, right? So they have access to a bunch of other services too, but they're a bank, and it makes sense that if Wells Fargo has 1,000 locations open and they're paying employees, paying property tax, insurance, just upkeep, right? Whenever repairs need to be done, just paying the rent or whatever it is on the actual properties that they have, they're going to be massively in the hole compared to something that SoFi is able to do. And at the end of the day, people would rather have their money in an online bank, right, that has a high interest rate than in a physical bank that has a lower interest rate or whatever it is, right? That charges more interest maybe when you take out a loan. Who's gonna take out loans from Wells Fargo if they're charging an extra percent on their interest rates because they have all these physical retail locations? So it looks like they're just closing them down as an overall trend. Bunch of banks closing out, so scary to see it. Scary to see it. So Vivi makes a good point. He says, like the video, friends. And that would certainly be much appreciated. It looks like we've got about 80 viewers on YouTube. We've got about 15 on Rumble. And let's give this stream some love. Let's give it some love. Let's smash the like button as hard as we can. And maybe, if we hit it hard enough, maybe the markets will turn around. It's not a guarantee, but it's a possibility. So it looks like Sundial. Look at this. Sundial getting decimated, down 13%. We are really getting provided. I mean, Sundial, talk about a great one to be buying on a big dip like this. I will almost certainly have to be entering Sundial later today, but talk about a great one to be buying that has plenty of cash on the balance sheet and just bought Alcana. Talk about a great option, right? Because you don't have to worry about them going bankrupt. They've got a ton of cash and investments. Obviously, their investments are probably down with the overall market right now, but they've still got a bunch of cash. So I'm not worried about Sundial going bankrupt, and it just seems like such a juicy opportunity at this point that at peak fear, obviously, Sundial is going to be getting crushed, right? It's a cannabis stock. Nobody likes those. None of the big players like those, and it's just been on this perpetual downtrend. Of course, it's going to get crushed very harshly towards the bottom, probably, of this dip that we're seeing in the market, right? I would expect Sundial to be one of the ones that gets crushed the most. So we'll see what happens. I mean, it's probably, in my opinion, going to be one of the biggest rebounders too. Maybe not the biggest rebounder, but a big rebounder, right? So we'll see. Have you seen the Utopia short movie from Costa Nicas? I've never heard of that. The Utopia short movie. That sounds kind of cool, though. I certainly like movies about utopias. And Silver says, if Dems win 2022, the cannabis stocks will be soaring. Yeah, we'll see. I mean, hopefully we get some news on it before then, right? Hopefully we hear. Let's see. Senate candidate sparks up. So, okay. Look at that. Look at that. So now Senate candidates are smoking publicly. Look at that. Apparently, or at least that's what the headline would have us believe. So the most important thing to know is you are living in the fourth turning. Things will get real scary real soon, says Coke Mojo. I hope not. I hope not. But it certainly seems like that's the direction we're heading in. I mean, look at this S&P. It looks like it's accelerating its downtrend. So somewhat scary stuff. Somewhat scary stuff to see. The S&P just tanking like that. But I am overall, like I said, guys, I am not worried about it. Obviously, there are real risks. Let me discuss those, right? Russia being one of them. I don't want to talk too much more about Russia, but there are some real risks in the market. But overall, I'm not too worried about the overall markets, right? I think that inevitably the markets move down and inevitably they recover eventually, right? This is just one of those times when we've been moving up for so long that we really were due for a correction. But the corrections, once again, pretty much every time, whenever we move down in a big way, it's some of the most bullish times right after that, right? We see incredible price action for weeks or months, in this case, even a year plus, right after a big dip. So this is really setting us up for potentially really big profits. Obviously, there's always the risk that, this is going to be the one. This is going to be the world ender. And the markets go down to zero. Nobody wants to own companies anymore. There's always the risk. I just don't happen to think there's a very high chance of that happening. It seems like, historically speaking, if you look back at all time, people have always wanted to be in the market. So let me also pull up this historical S&P 500 gains. So let's find this thing. Let's see. Let's see if this is a good chart for us. No, we don't want that. That's no good. No, not that. Come on, we had a good chart a while ago. This might be it. No. Come on. We had such a good chart. We had such a good chart the last stream, and I should really bookmark some of these. Let's see if we can't find it. Come on, because this is a really cool chart. Let's see if this pulls it up. No. Maybe this. This could be it on Yahoo Finance. It's not the prettiest. If we could change this from a line graph to a bar graph, I would like that more. So we won't use that one. Man, this is crazy. I don't know why. We had such a nice chart showing the average gains in the S&P before. And I just don't know where it's gone. It just completely disappeared. So let's see. This is crazy. So I have no idea why this search result is not. Because I had the freaking thing set to look at that. That's crazy. I had the search indicator set to the past week because I was looking for that other thing. Here we go. There we go. So basically, you guys have seen this chart before if you're watching the stream last Friday, but these are the gains that the S&P has seen year by year. And the green bars, obviously, are big gainer years. The red bars are the loser years. And we're going back all the way until 1928. But what's interesting is that you can see it's not just the average 12% gain that you see going up and up and up. You actually, and Ivan asks a good question, are you selling or holding Sundial? I am holding and probably buying more today, right? It's gotten really cheap, so I'm probably buying some more. It's looking too juicy at this point, right? It's just been getting crushed. And it's the kind of stock that I'm not worried about in 3 years, regardless of what happens in the market. I mean, as long as we see legalization, it's going somewhere, right? So I'm not worried about it. At some point in the next while, as long as we see legalization, I'm not worried that Sundial is going to be worth a lot more than what it's worth now. So I am probably buying more Sundial, right? I'm not selling, not holding, I'm buying. But we'll pull up the S&P right here. So we've got this S&P chart, and you can see that we see pretty big gains on the up years, right? We're up 34%, 20%, 31%, 26%, 19%. More recently, we've been up 28%, 16%, 26%. And that all has to get balanced out because on average, the S&P goes up, if you average all the years together, about 12% per year. So that has to get averaged out by, in 2008, minus 38%, minus 13%, minus 23, minus 10, minus 6, minus 7, what we're currently sitting at in 2022. So a lot of the times you will see down years. Now, what's important to note is that we are currently in a down year right now. And sometimes it's the case that you're in a down year and it then turns green by the end of the year. Now, will that happen? Who knows? We certainly have printed a lot of money. We certainly haven't had very many red years since 2008. Maybe the Fed doesn't want it to happen. We'll see what happens with it. But I am overall willing to hold through the red years, accepting that, hey, sometimes it's going to fall 30% or whatever, and maybe I can catch it. But maybe I'm catching a knife that's already hit the floor, right? Maybe it's already down at the ground, and why would I sell, right? Maybe I'm dropping a knife on the ground. Basically, is probably a better way of saying that. Instead of catching a falling knife, maybe you're just placing the knife down on the ground, letting go of it, when really maybe you want to be picking it up, right? So obviously, we can't say if that's the case right now. We don't know if stocks are going to be dropping more. It certainly looks like they will be going down a bit more, but you never know when they're going to rebound, right? They could be getting significantly more expensive pretty much as soon as this thing turns around, right? It would be my expectation that we'll turn around in a pretty fast way. Look at that Sundial on big volume down to 40 cents per share, just getting decimated. And we'll pull up, let's see what's DWAC doing, down 8%. So it's not as bad as Sundial, but getting pushed below 70. Still, though, if you bought into DWAC 30 days ago, you're still pretty green. So that's something the whole market can't say, right? You're still pretty green. If you bought in 30 days ago into DWAC, it beat the S&P. Look at that. We're at 30-day lows on the S&P, and we've still seen some significant gains on DWAC. If you bought into that at the lows, or not even at the lows, we'll do it at $48 to where we are now. You're up 40%. So good job, anyone who was doing that. You're still up pretty big on DWAC, if anyone was buying into that. So congratulations, despite days of declines. We've been falling for a while, since $93. So good job. The markets, though, hopefully they'll turn around sometime soon, right? We're down about 2% on the day now. We started down about 1.25%, and it looks like we've continued falling. Obviously, people think that the Fed's going to do something bad, and I will point out that what to look for this week, right? We've got a couple of things going on. First off, we have tomorrow consumer confidence for January, which I would expect probably to be lower than the forecast, right? I think that especially now, consumers are a little bit worried. Now, on Wednesday, we actually have some really exciting stuff, right? We have a Fed statement, a Fed interest rate decision, which is probably going to remain the same at 0.25. I don't think they would blindside the market like that and raise it all at once. And we also have a Fed press conference. So a bunch of exciting stuff going on Wednesday. That's probably going to be pretty relevant day to the markets and potentially an inflection point. Maybe we'll see the market start to turn around that day if the Fed really comes out and just tries to calm everyone down. I think that oftentimes before you see these kinds of interest rate decisions, you might see some of the bigger players, the ones who have that kind of influence, who can really move markets, you might see them pushing stuff down to get easier policy at the Fed, right? Maybe they end up losing money on this push down, right? They decrease their net worth with this push down, but overall, their net worth might be high enough so that they benefit enough from not having interest rates go up 0.25% because, maybe they have out some big loans or whatever, big margin or whatnot, that it might be worth it to them to lose, 1% of their net worth that they've got invested in these stocks that have moved down just to get that higher, to keep that interest rate from going up. You never know. You never know what kind of manipulation's going on out there. It goes around on both sides, right? So that's what we've got for today. It is now just about 10:30. My clock says so. Thank you guys for joining us. Even though it was a very red day, that just goes to show that you guys are some of the most resilient investors out there, that you can actually watch these charts fall and tank and watch your portfolios potentially get decimated and still stick around for the next day, the next week, the next year, and keep investing. So that's really cool stuff. Good job, guys. I'm very proud. And other than that, we're logging off. So I'll see you guys tomorrow at 9 sharp. We'll see you for another very red day. Hopefully our accounts won't be at 0 by then, but you never know. So I'll see you tomorrow, guys.